What if the most celebrated milestone of adulthood isn't an investment at all, but a beautifully packaged expense? Take a quiet second and think about how often you've heard it. Renting is throwing money away. It's repeated at dinner tables, on morning talk shows, and by well-meaning relatives who believe they're handing you the keys to financial security. The message feels unquestionable. Buy a house, build wealth, sleep better at night. But here's a thought that makes people uncomfortable. Simply owning something expensive does not make it an investment. An investment, by definition, should put money back into your pocket. It should work while you sleep. It should produce. A home you live in does something important. It gives you shelter, stability, pride. Those things matter. But none of them automatically generate returns. And when we confuse emotional value with financial productivity, we risk making the largest purchase of our lives. For the wrong reason. If we're going to make a rational decision, we need to start with definitions, not opinions, not traditions. Definitions. In investing, words matter. An asset is something that produces cash flow or appreciates because it is productive. A farm grows crops. A business sells products. A share of stock represents ownership in earnings. These assets generate output. They create value beyond their purchase price. Now consider a primary residence. It does not send you a quarterly dividend. It does not distribute profits. It requires ongoing payments to exist. Mortgage, taxes, maintenance, insurance. The money flows outward. That doesn't make it foolish. It makes it consumption. And consumption is not a crime. We all consume. The key difference is honesty. When you label something correctly, you can evaluate it clearly. When you mislabel consumption as investment, you begin expecting returns that were never designed to appear. And that misunderstanding is where costly decisions quietly begin. Once you understand that a home is primarily consumption, the next step is examining what it truly costs to consume it. Most people focus on the monthly mortgage payment as if it were a forced savings plan. But in the early years of a 30-year loan, the majority of that payment is interest. You are not paying yourself. You are paying the bank for the privilege of using its capital. That money never returns. Then come property taxes, an ongoing obligation that does not disappear when the mortgage does. In many counties across the United States, those taxes rise steadily, regardless of market conditions. Maintenance is quieter, but relentless. Roofs age, water heaters fail, paint peels. A common rule suggests setting aside 1 to 2% of the home's value annually just to preserve it. Insurance protects against disaster, yet it is another check written each year. And when you eventually sell, transaction costs can consume a meaningful portion of accumulated equity. Add these together, and you may discover something surprising. A significant share of home ownership costs behaves remarkably similar to rent. At this point, someone usually says, yes, but homes go up in value. And sometimes they do. The real question is why. Over long stretches of history in the United States, residential real estate has tended to track inflation more than dramatically outperform it. In other words, much of what feels like growth is simply the dollar losing purchasing power over time. Nominal prices rise. Real purchasing power often moves far more slowly. There are periods of explosive gains, often fueled by easy credit, population shifts, or speculative enthusiasm. But leverage magnifies both directions. Borrowed money can make modest appreciation look extraordinary. It can also turn modest declines into painful losses. When people describe their home as their best investment, they are often remembering a fortunate entry point combined with decades of debt repayment. That experience is not guaranteed. Price alone does not determine return. Productivity does. And a property's value depends heavily on what someone else is willing and able to pay in the future. In the stock market, no disciplined investor buys a business without considering its price relative to earnings. Paying too much, even for a wonderful company, reduces future returns. Real estate deserves the same discipline. There's a simple measure that brings clarity: the price-to-rent ratio. Think of it as the housing market's version of a price-to-earnings multiple. You divide the purchase price of a home by the annual rent of a comparable property. If a house costs $600,000 and could rent for $30,000 per year, the ratio is 20. That number matters. Historically, lower ratios suggest more attractive long-term economics for buyers. Higher ratios imply thinner returns and greater dependence on appreciation. When multiples stretch into the mid-20s or beyond, as they have in several major American cities, the math begins favoring the renter. Because when you overpay for any asset, your future return quietly shrinks. And that brings us to the cost few people pause to measure. Let's pause here and consider something that rarely gets discussed at backyard barbecues: opportunity cost. To purchase that $600,000 home, you might put down $120,000. That money feels responsible. It feels committed, but once it is placed into the walls of a house, it becomes idle capital. It does not compound. It does not diversify. It simply sits. Now imagine that same $120,000 invested in a broad collection of productive American businesses. Historically, equities have delivered average annual returns in the high single digits over long periods. Compounded over decades, that difference becomes staggering. The question is not whether a home can appreciate. The question is whether it will outperform alternative uses of capital with similar risk. When you concentrate a large portion of your net worth into a single property in a single zip code, you are making a focused bet. Sometimes focused bets succeed, but diversification has been a far more reliable partner to wealth. Capital is precious. Every dollar can only be allocated once, and where you choose to place it determines how hard it works for you. There is another dimension to capital that balance sheets rarely capture: flexibility. In a dynamic economy, opportunity does not send advance notice. A better job offer may appear across the country. A new industry may flourish in a different state. Costs of living can shift. Tax policies can change. When you rent, movement is relatively simple. When you own, movement becomes a transaction, one involving agents, fees, inspections, negotiations, and time. Friction increases. Optionality decreases. Liquidity is not merely convenience, it is protection. Cash and marketable securities can be redirected quickly. A house cannot. Risk is often defined as volatility. I prefer a simpler definition. Risk is losing the ability to respond when conditions change. Owning your residence may provide emotional stability, but financially, it can anchor you precisely when agility would be most valuable. At this stage, a thoughtful objection usually emerges: "But my mortgage payment is fixed. Rent keeps rising." That observation has merit. A fixed-rate mortgage does create predictability. In an inflationary environment, locking in a payment can feel reassuring. But only part of the expense is fixed. Property taxes adjust. Insurance premiums reflect climate and replacement costs. Maintenance follows labor and material prices. The total cost of ownership rarely stands still. Meanwhile, productive assets, businesses with pricing power, also tend to adjust with inflation. Earnings rise. Dividends grow. Market values respond over time. The question is not whether a payment is stable. The question is whether your capital is compounding at a rate that meaningfully exceeds your housing costs. Stability alone does not guarantee wealth. Now, none of this means buying a home is inherently wrong. Context matters. If you plan to remain in one place for a decade or longer, transaction costs spread out. If the price-to-rent ratio in your area is reasonable, the economics improve. If customizing your space brings daily satisfaction that outweighs financial trade-offs, that has value too. The key is intentionality. Buying because it aligns with your long-term life plan is different from buying because you feel pressured to keep up. A home can be a perfectly sound choice when it fits your timeline, your balance sheet, and your temperament. But it should be selected with the same discipline you would apply to any significant capital allocation decision. And that brings us to the larger principle. Here is the larger principle. Wealth is not built by owning impressive things. It is built by owning productive assets. Businesses that earn. Shares that represent growing profits. Bonds that pay interest. Assets that generate cash flow whether you are awake or asleep. A primary residence provides utility. It gives comfort, security, memories. Those are meaningful returns, just not financial ones. When people rely on their home as their primary investment, they concentrate risk in a single, illiquid asset tied to one local economy. That may work out, or it may not. The discipline is simple, even if the decision is not. Allocate capital where it has the highest probability of compounding over time. Buy a home because you want to live in it. Build wealth by owning what produces.